Silver used to be boring, that was the point. It wasn't supposed to be exciting, it was a hedge, a store of value, something you held when you didn't trust other assets to stay stable. Gold got the attention, but silver was the practical choice. Cheaper, more accessible, less speculative. That's not what it is anymore. And the shift didn't happen with an announcement. It happened quietly, over months, while analysts kept using words like volatility and temporary and market conditions, words that suggested this was normal, manageable, nothing to worry about, except people who actually hold silver, who watch prices, who use it as part of their financial strategy. They noticed. Prices started swinging, not gradually, not predictably. They'd spike, then crash, then stabilize briefly before moving again. The kind of movement you'd expect from a speculative asset, not a traditional hedge. At first, analysts said it was temporary. Supply chain issues, industrial demand fluctuations, short-term market adjustments, the usual explanations for unusual behavior. And those explanations made sense for a while. But then the timeline kept extending. Temporary volatility that was supposed to last weeks stretched into months, then into a year, then longer. And at some point, analysts stopped calling it temporary. They just called it the current market environment, as if volatile and unpredictable was the new baseline, not an aberration. Nobody said that explicitly, but the language changed. Instead of prices will stabilize soon, it became investors should prepare for continued volatility. See the difference? One suggests the problem is ending, the other admits it's not. Here's where it gets more complicated. Silver prices don't move the same way everywhere. They should, mostly. It's a global commodity. But when you compare what's happening in the US with what's happening in Turkey, the differences are stark. In the US, silver is expensive but somewhat stable relative to its recent volatility. There are swings, yes, but within a range that traders have started to anticipate. In Turkey, silver prices are behaving like a different asset entirely. They're spiking unpredictably, dropping sharply, rising again without clear triggers. The kind of movement that suggests something beyond supply and demand is driving the price. And what's driving it is trust, or the lack of it. When people don't trust their currency, they move into tangible assets. Gold, silver, real estate, anything that holds value when paper doesn't. In Turkey, the lira has been unstable for years. Inflation has been high and persistent. People don't trust official assurances that things are under control, so they buy silver. And when demand surges without corresponding supply increases, prices spike. But here's the thing, that's not supposed to affect the global price significantly. Turkey isn't a large enough market to move global commodities by itself. So why are prices moving so dramatically there? Because it's not just about Turkey. It's about what Turkey represents. It's a signal, a warning. When people in one country start hoarding tangible assets because they don't trust their financial system, it raises questions about whether the same thing could happen elsewhere. And those questions create their own volatility. Investors see prices rising in Turkey and wonder if they should hedge. That increases demand. Demand increases push prices up. Higher prices make silver look more speculative. Speculation creates more volatility. It's a cycle, and once it starts, it doesn't easily reverse. US analysts writing about this don't usually frame it that way. They talk about emerging market pressures, regional instability, currency depreciation, technical language that obscures the simpler truth. People don't trust the system, so they're moving their wealth into things that can't be devalued by policy decisions. And the more that happens, the more silver stops behaving like a stable hedge and starts behaving like a panic asset. That's the shift, and it's not temporary. Because even when prices stabilize briefly, the underlying conditions haven't changed. Currency concerns haven't disappeared. Inflation expectations haven't normalized. The reasons people are moving into silver are still there, which means the volatility isn't a disruption. It's the new normal. But nobody wants to say that. Institutions that track precious metals keep issuing reports saying the market is adjusting. Adjusting to what? They don't say. Just adjusting. As if that explains anything. Financial advisors who used to recommend silver as a safe, stable hedge now add disclaimers. They say it's a hedge, but it comes with increased risk, which is like saying it's a stable investment, except for the instability. That's not a hedge, that's speculation with better PR. And everyday people who bought silver years ago because they wanted something reliable now find themselves checking prices daily like they're trading stocks. That's not what they signed up for, but what are they supposed to do? They can sell, take the loss if prices are down, or the gain if they're up, and move into something else. But move into what? Cash that's losing value to inflation, stocks that swing just as much, bonds that don't keep pace, so they hold, and they adjust. They stop thinking of silver as a stable asset and start treating it like everything else, unpredictable but maybe better than the alternatives. That adjustment is the story. Because when enough people adjust their expectations, the old standard disappears. Silver was supposed to be the boring, reliable option. Now it's not. And instead of addressing why that changed, institutions just updated their guidance to reflect the new reality. They didn't fix the problem, they redefined normal. Here's what that looks like in practice. A few years ago, if you bought silver, you expected the price to stay relatively flat, maybe a small increase over time, but nothing dramatic. It was insurance, not investment. Now if you buy silver, you're told to expect fluctuations, significant ones, and to hold long-term because short-term movements are unpredictable. That's not the same product. That's a fundamentally different asset class, but it's still being sold as a hedge, and when people point out the contradiction, they're told the market has evolved, that conditions have changed, that this is the new environment, and everyone needs to adapt. But why did conditions change? What caused silver to shift from stable to volatile? And why is that shift being treated as inevitable, instead of something that could be addressed? Those questions don't get answered, they get deflected. Analysts will talk about industrial demand, mining output, currency fluctuations in developing economies, all real factors, but none of them fully explain why a commodity that was stable for decades suddenly isn't. The real explanation is simpler. People stopped trusting the systems they used to trust, and when trust erodes, tangible assets become more valuable and more volatile at the same time. More valuable because people want them, more volatile because that demand is driven by fear, not by need, and fear doesn't create stable markets. In Turkey, this is obvious. People are buying silver because they don't trust the lira. They're not investing, they're protecting what they have. And that desperation drives prices up in ways that have nothing to do with the actual value of silver as a metal. In the US, it's less obvious, but the dynamic is similar. People aren't panicking yet, but they're hedging. They're diversifying into tangible assets because they're not confident in the alternatives. And that hedging behavior creates the same volatility, just less extreme, for now. But the trajectory is clear. As trust continues to erode in currencies, in institutions, in the idea that systems will protect value, more people will move into tangible assets. And the more people do that, the more volatile those assets become, which defeats the purpose of holding them in the first place. That's the trap. The hedge stops being a hedge when everyone needs it at once. And we're watching that happen in real time. Silver prices didn't return to their old stability. They just stopped being discussed as if they would. Analysts moved on, reports changed their framing, and the public was left to figure it out on their own. Nobody admitted they were wrong. Nobody revised the guidance to say we thought this was temporary, but it's not. They just quietly updated the language and moved forward. That's how accountability disappears. Not with denials, with silence. And the burden of that silence falls on the people who trusted the original guidance. The people who bought silver thinking it was stable, who structured their finances around the idea that this was the safe option. Now they're holding an asset that swings like a speculative investment, but doesn't offer speculative returns. It's the worst of both worlds. And when they ask why this happened, they get explanations about market forces and global dynamics and evolving conditions. All technically true, none of it helpful. Because the real answer is, trust broke down, and nobody knows how to fix it. So instead of fixing it, institutions just recalibrated what normal means. Volatility isn't a problem anymore. It's a feature. Risk isn't a bug. It's the market environment. And if you can't accept that, well, maybe you're not suited for this kind of investing. That's the message. Adapt or get out, but don't expect things to go back to how they were. Which is fine if you say that from the beginning, if you're honest about what's changed and why. But that's not what happened. What happened was a slow reframing, a gradual shift from this is temporary to this is normal, without ever acknowledging the transition. And the next time something similar happens, a different asset, a different market, a different crisis, the same pattern will repeat. Officials will say it's temporary, timelines will stretch, explanations will change, and eventually, everyone will just accept the new baseline, because fighting it requires sustained attention and collective action, and most people don't have the time or energy for that. They have to work, pay bills, make decisions with incomplete information, so they adapt, they adjust, they stop expecting stability and start navigating instability. That's what institutions are counting on. Not agreement, just exhaustion, and it works. Silver isn't stable anymore. It's not going back to being stable. The conditions that made it stable don't exist anymore, but nobody will tell you that directly. They'll just keep using words like volatility, and market dynamics, and evolving conditions, and you're supposed to figure out on your own that temporary meant indefinite, that the hedge isn't hedging anymore, that the safe option isn't safe, and that the next time you're told something is temporary, you should assume it's not.